What's up, guys? Welcome back to another episode of Behind the Facade. In today's show, I am going to be crossing the Atlantic to New Jersey in the US, and I'm going to be speaking with a chap called Anthony Scandariato. Yeah, Anthony is a young man. He's still only in his 20s, and he has a wise head on his shoulders, I can say, because in the past 4 or 5 years, he has gone from buying his first multifamily investment, which was just 2 units. He did that whilst holding down his full-time job as an analyst at a real estate company. And he's gone from that, and in just 4 or 5 years, he is now today running his own real estate investment and management business with more than 600 units under his and his business partner's control. Now, how did he do that so quickly? Well, that's what I'm going to let Anthony explain today on the podcast. But just to kind of cut through a little bit of it, he basically used investment syndication as the methodology to scale his business. Now, what is investment syndication? To those of you who don't know, that is where you go out and sell a small segment, a small piece of your deal to lots and lots of different investors. And so you end up with a smaller percentage of the overall deal, but you do get fees for managing, for putting the deal together. And where you get really well paid is if the deal does well, you get a much, much bigger percentage of that profit. The syndication methodology here in Ireland, anyway, got quite a bad name for itself back after the last crash back in 2008, because an awful lot of those syndications that were put together, they went bust. But they didn't go bust because the methodology is inherently flawed or anything like that. They simply, the guys that were making the investments for them were buying at the very, very top of the market. There was a kind of, I suppose you could call it greed, just simply like flooded the market. And the fees that could be generated from the syndication method, and by being able to charge your investors so much, and if you made these outsized profits, you were able to get huge magnified returns on that. And so a lot of people went into that space, a lot of people bid up the properties, and in the end, the whole thing went wallop, as we know. If you've got a manager with a conservative and risk adverse kind of approach, or a low risk approach, then the whole thing can work an awful lot better. And Anthony is clearly doing something right, as he'll be explaining today. So look, I'm going to stop talking now. I'm going to let Anthony tell his story. So without further ado, my conversation with Anthony Scandariato. You are listening to Behind the Facade, the #1 podcast for investing with a particular focus on the real estate and property investment market. I am your host, Gavin J. Gallagher, and on this podcast, I'm going to be exploring the mental and emotional game often playing out subconsciously, both in your mind and the mind of everyone else in the real estate market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Anthony Scandariato, welcome to the show.
Gavin, thank you for having me. I really appreciate it.
Not at all, Anthony. It's nice to have you. So you're calling us from New Jersey in the US, that's right?
That is correct. Yep. New Jersey, about 40 minutes outside of, to put it in perspective, Midtown Manhattan, west.
Okay. Yeah. I mentioned that my brother lived in Hoboken for 10 years. So yeah,
yes.
I know the area, and I used to love visiting New York. I actually owned property in New York for a couple of years. So it's really, I'm delighted to have you on the podcast today. And your background, I'm particularly interested to kind of explore into how you've established a multifamily sort of investment sponsor and management company. And so, I have a good audience here from a mixed age category, and also, investors, developers, and then people wanting to learn. So there's always lessons to be learned from these conversations. Just to kind of kick off the story, Anthony, give us a little bit of your backstory. I mean, starting with, your upbringing and what your journey to kind of entering into the whole real estate sector in the first place.
Yeah, absolutely. Graduated from university here in the States in 2014. I had a startup company that I ran with a couple of partners from basically 2011 to 2004, late 2014. And I got into the real estate business in 2015 after running that startup. It was in retail, consumer products. Had a couple other partners. They're a little bit more passionate than I was. So, but that's a good thing because sometimes you got to learn to move on. So I was able to, exit from that and move on to really pursuing my passion, which is real estate investing. Right. And didn't know it at the time, but I just, I have some family in the business in different, parts of the business, but, got to learn from them and, really wanted to, make an impact on the industry at some point. But at that time, I just wanted to learn as much as I could. So I ended up working for, finding a job just through networking with different people. I must network with, I don't know, maybe 1,000 people for, wow, I don't know, maybe a couple months after I left my startup, because I wanted to figure out, I knew I wanted to be in real estate, but I didn't have anything lined up. I was still learning. I was reading books. I was listening to podcasts. I was watching video, YouTube videos, a couple of different ideas, looking at a couple of deals, and, ended up landing a position with the firm that was buying Class A office here in the States, up and down the East Coast, multi-tenant investment grade properties. So, I ended up working as an analyst there to start from 2015 to 2020. And then, I saw everything. I was, working, definitely more, a lot of typical, analyst position, working a lot of hours in the beginning, and actually throughout the whole time, but basically, learned a lot and, saw the acquisition process. I was involved, actually, was able to add value on the, finding deals for the company, help grow their portfolio from about, when I started, maybe 4 million square feet to about 8 million square feet, or 7.5. So basically doubled it in that 5-year period, or helped doubled it. And was very fortunate to be around people who have been in the industry for a long time, 30, 40 years, and was able to help capital raise for the firm, was able to, like I said, source opportunities, was able to be involved with asset management, was able to be involved with property management, construction management, development, you name it.
So every aspect of they really gave you the kind of, the ability to kind of learn all of those aspects. That's super helpful. I mean, and just having guys that have experienced, this business, you can learn it by yourself, but it's so much more helpful if you can have somebody who's got a couple of years of experience just to kind of steer you in the right direction.
Absolutely. So it was really a blessing, and, was able to leverage what I learned there, even though it was office, very difficult asset class, especially right now. I mean, you could do well in certain areas. We had our own niche where we were doing well. And then, 2016, kind of like late 2016, was there for a couple of years. So felt comfortable to buy my first property on my own. It was a very small investment for me. It was like, in the US, it was maybe like $25,000 investment, and wanted to buy it myself. It was a duplex property in the town I actually grew up in.
Okay.
So was able to, buy that property, was able to, I had to evict both the tenants. I did it myself. So I learned the landlord tenant court very quickly, and, was able to re-tenant that for higher rent, was able to go in there, do the renovations myself, and then re-rent it for a higher price. And
so you rolled your sleeves up in a big way, and you actually did a lot of the work yourself rather than hire in people to do this.
Yeah, because I wanted to learn. I remember I had my friend help me change the locks with the constable. So so learned a lot, and was able to basically take that investment and use it kind of a case study, because I got all my money out in like a year just from the cash flow. I didn't refi.
Okay, nice one. And tell me this, just in terms of the deal, you say 25,000. Include your debt level
with closing costs. Yep.
With closing
it was
costs, wow.
it was a higher leverage loan at the time, but it was for basically first time home buyers within a certain income limit. And it was like 5% down type of thing. I did move in there. I ended up moving out, but was able to basically take advantage of that.
I can see it. Like if you're able to get a 5% down loan, then it's a really good way to start your career.
At 2.8%. I mean, so on our podcast, we talked about low fixed 30-year fixed rate debt. So I felt comfortable with that. And it's probably like 60% leverage now based upon the value, but that could turn. But I don't care because it's 30-year, really low debt. So that was my first one. And then my second one, I ended up partnering with another individual, actually a family member, but we ended up doing the same thing. We bought a 2-unit, it was vacant in a town that we, both of us knew, cleaned it up, repositioned it a little bit, and got new tenants. Actually had to evict the tenants again and got new tenants in there. Rented it for, I think it was maybe 100% more than what they were getting before. And then we decided to sell it. We were looking at the IRRs and our equity multiples, and we are like, let's just get out of it. We'll make 3x our money. It was like a 40% IRR. It's a 2-family. Why the hell we want to hold this? So we sold that. And
3 extra money though. It's nice. Yeah.
In a year. So that's why we were like, let's get out of it and put the money somewhere else. Yeah. So I ended up selling that with the partner. That was my first partner experience too, part-time. This is all easy stuff.
So you were working full-time in
2-family, you can handle that, couple units. And then in 2017, I met my late 17, I met my now business partner, Brian, through a former coworker. He played for the NFL here, and he was, retired and had some capital from playing for 8 years, but was in his early 30s, and a lot of those, NFL players kind of go broke quickly and spend their money.
I've heard some incredible stats that, something like 70% of them are bankrupt within 5 years of retirement.
Probably more than that. Yeah. So he didn't want to be one of those statistics he was reading a lot about multifamily, et cetera. He came into our office one day and we met each other, and I told him I was buying some small multifamilies, and he's like, oh, that's exactly what I want to do. But I don't want to do it alone. So it's like, all right, well, maybe we can look at some deals together and see what we can work out. So we got to get to know each other for a few months. And then we ended up buying our first deal together in I think it was 2018. It was a 10-unit mixed use property. So ground floor retail, apartments above. We took the NOI from like 90,000 to 160,000 in a year. Actually, it was less than that. It was like 8 months. Very mismanaged property.
In terms of just the jump in scale for you, was that a significant jump in scale from your previous deal?
Yeah, like I said, I was buying 2-family units, 2-family here, 2-family.
And then you're going to 10 units.
Going to 10. It was a straight up partner, joint venture, straight up partnership. You just whatever. If I could put in 50,000 US and he put in 200 US, it was just whatever you put in was what you're getting.
Okay, so it wasn't a 50-50 venture. It was he's like a capital partner, and then you're the person who's rolling up your sleeves and doing.
No, we both rolled up our sleeves.
Oh, okay.
So
great.
Because we had the vision of, okay, let's take, at some point we want to do larger deals, and let's take it to, I didn't even argue with it. It's just, okay, I'm on the same page.
Yeah, it makes sense.
So we both, did the management ourselves, and obviously I was working, so he spent more time at the property. And so we ended up buying that. Like I said, we took the NOI quickly. He saw what the power of that is. We ended up doing a cash out refi on that. We still own it. Very low fixed rate debt. We took it, and we ended up refinancing that. We took the cash. We put it in another 10-unit property, 1 retail, 9 apartments. We did the same thing there. So we basically went from a 10 to another 10 to a 13 to a 20 and a 12. So we bought about 70 units together, just the two of us, within basically from 2018 to the end of 2019. So a couple year period.
That's pretty fast. Wow.
But it was our money. So I wasn't taking on anybody else's money.
But it's great that you could do that in that space of time and not have to give up any additional equity, because you've got a partner now who has enough money to be able to kind of roll into the first deal, and then you can just continuously use the cash from the previous deal to roll into the next one.
Yeah. Obviously, it was all time dependent too, but I single at the time and very low expenses, so I was able to do that. Not married, and obviously that helped. And so basically, once we started to refinance a couple of these deals in late 2019, I found an opportunity. It was 49 unit building. 48. We ended up adding a few units, so now it's 51. But we ended up looking at that. It was like a $5 million US property, and in our backyard, very mismanaged, very under rented, a lot of upside, and we wanted to buy it. But I was like, listen, this is $5 million property. We're gonna have to put in $2 million of down payment. That's for me, it's not going to happen. And so why don't we end up partnering with other people and syndicating and whatnot, bring on financial resources. So yeah, we ended up syndicating that. And that was our first larger deal. We brought on like 15 investors, and those were all his friends and family, my friends and family, just through our network. And whatever, everybody put up 50 to 100,000 a piece, and we ended up buying it, just traditional syndication. And that was our first larger deal. And interestingly enough, when we got under contract, pretty much a couple weeks after, it was just like in December, no, November 2019, owner from the property, there's another multifamily property behind the one we were buying, who wanted to sell off market and found out we were under contract or whatever, and asked us if we wanted to buy it. And I was like, yeah, it makes sense. Scale, why not? And it was a 64 unit building. So we actually went under contract with that. And then I left my job. So
it made
sense. It was like,
it
was
stage.
too much. Too much. So, so ended up leaving there full time January 2020. And
before the COVID situation,
before the COVID,
yeah,
we had another property we got under contract near us as well in like February or early March. And then obviously, the COVID pandemic happened and everything closed. It just took longer because the banks dried up and whatnot. People wanted to see what happens. But yeah, I mean, we were, constantly networking, trying to find new partners, investors. And so we, basically I leveraged the experience from working there. Basically, our portfolio as well. We were putting our money where our mouth was. We were investing in the syndications too. So it wasn't like I didn't have any skin in the game, nor my partner.
Of course,
so we ended up, closing on those they ultimately closed like Q2. They were supposed to close Q1, but we ended up buying those. And then obviously we basically went from the 70 units at the end of 2019 to now we have 640. I'm under contract for a few other things now, which will bring that number
scaled up significantly since then. Yeah. Wow.
Yep. Yeah.
That's really impressive.
Yes.
And in terms of obviously I've done syndication before, and one of the attractive things about it is you can invest in the deal yourself. So you're going to get the upside but in addition to that, you have the benefit of being the promoter and the manager. So there's fees for all of that. So that pays you to basically, so that was how you were able to leave your job.
Yes. Absolutely. So it really where you make your money in the syndications on the back end through any capital type of events.
If you sell it, there's a kind of a success fee and things like that.
Yes, absolutely. Yeah. You have to hit certain return metrics for your partners and passive investors. So if I felt comfortable, and again, single, no kids, so it's easier for me to make that decision. And for me, it was like, this is going to be my one shot to do this. Why? Let's do it.
So at the time, you had 70 units with your partner.
Yes.
You had just entered into contract for 48. And then the 64 came up.
Yes.
And at that point, it made sense for you to kind of
had a conversation with my former boss in December. A few weeks notice. I had to do it. I didn't feel comfortable taking on people's money and then just being 1 foot in, 1 foot out. It just didn't make sense to me. I wouldn't feel comfortable with that too.
I think it's very important. Like, your reputation is everything in this business, and like your integrity. Clearly, you've got integrity to even have had that conversation, because I do know some people that would try to moonlight with, and keep their
do both. And it just wasn't going to work. And we were self-managing too. So that 48 unit property we were managing. I didn't even have a super. That was a mistake. But we were driving up to the property and pretty much every day for the first few months. But we were going at it. We were knocking on tenants' doors that weren't paying. We were doing cash for keys. We were doing all these crazy things. I was able to, we bought it for 5.5. We added units. We got the rent roll up like 40%. This is before the pandemic. We got most of it up. It wasn't just, market related. And we like to force appreciation. We don't just rely on, inflation's going to be, 8%. So let's just say that rents are going to go up 6%. It doesn't always work that way. So, we really invested money in where they needed to be, which was in kitchens and bathrooms and floors and exterior monument signage and landscaping, hardscaping, and adding units, reconverting old retail to apartments, which we did that on 3 of the units. So, yeah, we basically doubled the NOI there within a year. I did a cash out refi about 16 months later. Everybody got their money back. It was like a 22% return just on that. And we're going to
Just for
hold it for a little bit.
for the people that are listening that don't know what NOI, that's net operating income.
Yes.
And so, I mean, if you buy something and you've doubled your net operating income, you've effectively doubled the price of the property as well. And so,
Yes. Yeah.
so your
So
5 million you invested is now worth 10 effectively.
yeah, it appraised for 9.7. So yeah, so we took a loan out, paid all the investors back to initial capital, and then put it into something else, basically tax free. So yeah, so then that kind of helped us grow in 2021. We had a few deals we bought in 2020. We refinanced and we found new deals. But the thing with that is, you have a lot of groups I see, they don't even finish their business plan and they're already on the next deal, next deal, next deal. That's where they get into trouble.
Yeah.
At least
Yeah.
with these deals, we were able to give our investors principal back. We paid their preferred returns. We gave them more than that. So everybody's happy no matter what. And we're able to scale moving forward with the same
the
people
profits, basically. Yeah.
and the profits and the same people.
That's great.
We have
Yeah.
new people coming in all the time, but it's good to have that. And
That gives you great credibility as well.
well, the point I'm saying is you start building a track record, you have a following, you have, one investor comes in, they get a good deal, they tell their brother, their sister, their cousin, whoever, and they kind of come in. So it's good. And you kind of build your business organically. And I'm a little bit, it kind of hurts me a little bit because, I hear these guys, Grant Cardone, yeah, let's buy 1,000 units at a time, 2,000 units every quarter, whatever. I'm like, well, I kind of want to make sure that one's performing and then we'll start to look at more deals and then we'll start to, that's where you get into trouble. And I've seen
I think that's a wise move. Yeah.
So, so we're just trying to be strategic and we have the property management division too. So I have, a senior property manager and I have maintenance people at every every location. I have leasing people at every location. We have an accountant, a bookkeeper. So that's a lot of where my time is spent on, fortunately and unfortunately, but we, especially in the infancy of your business, I think property management is key. And I'm not like a vintage company yet. I'm still somewhat new. If I have one bad deal, it's going to be with me forever. And I'm almost 30 years old. So, property management is really a pain in the ass. It is. And this.
Yes.
And, but why not suck it up for a few years or a decade and really get it? Because that's really where, if you're buying existing,
it's the differentiator.
Properties, you have to know what to look for when you hire somebody in the future, if that's what you're planning to do. So it's a blessing in disguise, but it is a pain point.
and tell me this, Anthony, in terms of, I like to talk about the habits and the behaviors and the mindset that's really kind of made a difference in your business. I mean, have you identified any particular behavior or habit that really has kind of made a difference for you in building and scaling your business?
Yeah, I mean, putting good systems in place. My partners really helped with that. I was pretty resistant to it because I was used to just doing everything myself or whatever. But putting good people in place at certain, in certain roles, even if you are bearing the expense, and the more, as the more properties you own, you can kind of leverage that across all your units or properties, so that actually the costs go down the more you buy. Potentially. So
well, it also gives you the capability to scale because now you have these people in place, and so it might be costly at the outset, but every 50 unit building that you add to it is just incrementally bringing down that unit cost.
Yes, exactly. So that's how we're looking at it now moving forward, and that was one of the reasons why we like going up to the properties ourselves in the beginning. Was we were looking at the cost. We couldn't afford it really to have somebody help with that. We could afford a super. We were just trying to find a good one. And, so yes, the scale really did bring us the ability to leverage good people, to put in place and good systems. We have an investor management system. We have a property management system. We have, all workflow system. I have, a system for the media that we do and the stuff we put out as we're doing now, Gavin. systems do help you scale,
For
even
sure.
if you're looking at the costs up front. You just got to be strategic about it. The way I look at it too, like you said, okay, if we buy this property, maybe I can hire a VA to do this because it's not going to cost that much in the grand scheme of things across your portfolio. So, it's about growing smartly and trying to make, good decisions.
Yeah. And I mean, in terms of your ambitions for your business, I mean, have you, you're at 600 units now, you mentioned, what does the upper limit look like for you? Or do you think you can just continue to do this and scale?
Yeah. I mean, I think,
Is there a sweet spot, I guess, is what I'm
I
asking.
don't really have I don't really have, I need to be at 10,000 units. That's not, I don't know. I just don't, I never saw units that you could be at 10,000 units and own 0.0001%. And then it's just like you own 2 units, like
Yeah,
on your own.
yeah.
That doesn't do anything for me. So
It's
I
adding
guess
value and all that kind of stuff is
it's
part
adding
of it.
value, growing smartly, my growth's kind of been like, like this, which to me is
Gradual, yeah.
okay. It's not like this and then, this. And
You
so
don't want to be on the
it's,
roller coaster. Yeah, I've done that.
yes.
I don't
And
recommend it. Yeah.
we spoke about that. And, I'm a young guy. I didn't live through the real hard. I mean, I did, but I wasn't, really financially exposed, when the hard times really came around. So I try to position ourselves for when, because they will come. So it's not a matter of if, when they, position ourselves in a way for, still success, protecting principle is key too, at all times. So, you know, try to position ourselves in a way to hedge against that
I think
risk.
you watch your reputation, which clearly you're doing, and if you just keep a level head, I think one of the biggest problems with people in the business is, and it's a problem with entrepreneurship in general, is there's this whole kind of Instagram comparison lifestyle, and you see these accounts and the guy is showing off the latest Lamborghini, or he's wearing this big fancy watch in his hand or whatever. All of these things, I think they get inside people's heads and they kind of feel like that they need to play that game too. And
Mhm,
first of all, it makes you do stuff that you might not necessarily want to
mhm.
do, but second of all, there's also, it can put off the kind of investors that you want to have. I know
Yes.
investors that are just totally turned off by that kind of thing.
Mhm.
And you end up attracting people that aren't in for the long run. They're probably people that will cut and run as soon as there's any kind of a downturn, because they're probably quite up to their neck in debt. If you're living that kind of lifestyle, usually it's debt fueled.
Yeah, no, absolutely. And, I would be turned off by it. Even if it's something that you can afford and whatever, you pay cash first. You gotta bear the fruits of your labor too. But it's once you start putting it out there and flaunting it, it's not a good public image. I mean,
Especially when you're syndicating as well. Yeah.
people do it for different reasons. I'll use Grant Cardone as an example. I mean, it's just part of his brand, I guess. But I
Yeah.
guess I'm on the opposite side of the spectrum with that. And yeah, it's like, yeah, I'm showing off my private jet, and then let's say you just raised whatever $10 million for a deal, and it's like if you just showed your private jet off, and it's like, well, wait a minute, where did
How
the
much
money
of
actually
that?
go to? Yeah, did the
Yeah.
money actually go to the deal, or did you take a million or two and just buy it, or at least start a lease on a jet? So I don't know. Even if I did buy a jet, I wouldn't tell anybody,
Yeah. Yeah. You
or I
don't,
wouldn't put it out there. I know it's like I said, that's more of a market. It's
I
some
think it
kind of
is.
marketing
It's all
plan.
marketing. Yeah. I mean, if you follow his career, it's it's only about a couple of years ago he wasn't visible like that at all, and he suddenly made this decision to become, Uncle G, as he calls himself. And as soon as he became Uncle G, he was all flaunting it, the Rolls Royce and all that. Prior to that, if you look at his career, he was not like that at all. And I think he made this conscious decision to become this kind of real flaunted as part of the brand. And it was a
Yeah,
very,
yeah. It's nothing. Like I said, I actually like him. There's nothing wrong with what him and other gurus are doing. They have their own strategy behind it. But it's not for everybody, and
yeah,
it's
horses for
it's
courses,
it,
as we say.
it's different. So yeah, that's how we've grown, and just, a little bit of pain points along the way that we're still going through. But again, I'm all about trying to put good systems in place so we can move forward to the next deal, the next deal. It'll get to whatever amount of units it gets to. I
Yeah,
like to say maybe I like to have capital events from other deals and then put the money somewhere else. I don't,
I get you.
I do raise additional funds for different deals here and there. But it just has to make sense.
Yeah. I'm conscious of time, Anthony. I wanted to just ask you, of all the deals being in the kind of New Jersey area, you mentioned you did a lot of stuff in your backyard. Is that your strategy, just to stay in the area, or have you started to branch out?
Yeah, no, so we actually started branching out in 2020. We went to Pennsylvania, which is a border state of New Jersey. So that was our first out of state investment. So we're able to drive there still within an hour, whatever. So that we are branching out of state. I actually haven't bought anything in New Jersey in a couple of years, since 2020.
Right.
But we're buying in Florida. You mentioned, some
Yes.
people, and buying a lot in Florida actually right now. So we bought in New Jersey, we bought in Pennsylvania, we bought in New York State and Florida.
My brother lives in West Palm Beach. Yeah.
Yep. So
And just tell me quickly before we have to bring it to an end, the COVID, the emergence of COVID just after you started the business. I
yeah,
mean, how did that impact you initially? I mean, the lockdown must have been quite a worrying development. How
yeah,
did you weather it all?
yeah, absolutely. I had a different opinion. There was a lot of doom and gloom. I just I knew the government was going to step up and support the markets as much as they can, and they were going to cut rates. I don't know.
You had a feeling. Yeah.
History kind of repeats itself a little bit, and I just knew that was going to happen. And I looked at the historic trends. I didn't see, I just didn't see a collapse of 08, 09 happening, because it was totally different.
Yeah.
Um, you
Yeah. It
know,
wasn't speculative. It wasn't
yeah,
fueled by speculation. So it was, yeah,
it's
different.
a very different fundamentals. So I just, continuing to do what we were always doing. We're also buying high cap rate deals at the time. So I felt pretty comfortable with where the markets were, even if there was a crash. Let's say, the rates went up another 200 basis points, and I bought it at an 8 cap.
You
You
still,
know,
yeah, it's not going to make
yeah,
that much of a
so
dent.
it's just, we did sensitivity analyses, and we still continuing to do them. And we always try to protect the downside, try to be as prudent as possible. You can't control everything on the market side. But we try to set our portfolio up in a way where we, can weather the storm. But yeah, the eviction moratoriums were a problem. Fortunately, we were able to navigate it, obviously able to get through it. They're all lifted in all the states we own in. It's still kind of navigating through the courts right now. Some of the bad tenants, I can count on one hand though,
Oh,
out
that's
of the
good. Yeah.
portfolio, which is
I mean,
good.
at the end of the day, it hasn't hurt your initial portfolio income. What it's done is maybe slowed the progress towards increasing the NOI, because the tenants continue to have to pay, I guess, don't they? Unless, I suppose, they're just stopping and not paying at all.
Yeah, we had some that stopped and not paid at all. I have
Okay.
tenants who haven't paid for a whole 2 years now. But again,
There,
like I said,
that's one of
it's
the five.
one of the five. Yeah.
Yeah.
And then some other tenants, some new properties we buy, some of they have arrears, and now we're trying to get them out. So
Okay, I get you.
it's more of the tenants we've inherited, I would say, rather than
Right.
put in the first place. People have problems, right? And we understood that. And the tenants who had actual problems, they went and applied for rental assistance. It was a pain in the ass because we didn't get that assistance for 2 months, but we had adequate reserves, we had adequate cash flow coming in to weather the storm if we took a 10% hit on our collections for whatever
Yeah.
that month was. So yeah, so we were very fortunate. Hopefully, we're able to still get those those five bad apples out, and kind of move on with our life.
It's
Um,
worked out.
yes.
Because I had a guest on not so long ago, and he was telling me that the COVID, a lot of the people this guy is based in the UK, and a lot of the people that were in his kind of sector, it was serviced accommodation,
Mm,
they pulled out, and the COVID situation, as negative as it looked at the outset, it actually turned into a huge benefit to him. And he scaled his business by 4x during COVID. And it does seem like you've done something similar. You've actually used COVID to your advantage.
Yeah, like, well, because you can't, everybody was watching the news. I try not to nowadays.
Yeah.
But you just can't let it get you down, even if it was serious, and slow your path to progress. Yeah, you're going to have a lot more bumps than if you were, if it didn't happen. But I think it makes you stronger, not only from a business person perspective, but individual
Resilience.
perspective to get through, the resilient times. Just like, we spoke about before, when you were going through some times, this was another time to get through it. I mean, we had deals under contract where we had sellers that were older, and they didn't understand why we needed more extensions, because the banks basically said, nope, we're not doing anything right now. We want to see what's going on. We had to put up $500,000 US more, just to continue with the contract. And that, guess whose money that was? That was me. And, so we took a lot of risks that we were scratching our heads about, but paid off.
Fascinating. Well, look, Anthony, I watched in the time. Let us end it there. Can you just, for the people who would like to, learn more about you, can you just tell us what's the best way to find you?
Sure. Best way to find me. We actually have a special report on our website. It's called How to Leave Your 9 to 5 Through Real Estate Investing and Achieve Financial Independence. So our website's redknightproperties.com. That's Red Knight with a K. As soon as you go on there, it's like a free ebook that I offer. You just put your name and email in. I'll send it to you.
I'll put a link in the show notes so that people can find that. Yeah.
You'll get, with that email is my contact info and my partner's info. So, you'll just get an email with all that, and that, you can still find me anyway on LinkedIn, Instagram, Twitter, Facebook, either my name, Anthony Scandariato, or Red Knight Properties.
Well, I'm sure, Scandariato, nobody's going to forget that name. That's Anthony, thanks so much for your time, and look forward to catching up with you again in the future. Hope you're going to come and visit Ireland someday.
Absolutely. Thank you, Gavin.
All right, guys, I hope you enjoyed today's episode. Thank you so much for tuning in to Behind the Facade. If you enjoyed the show or found it useful in any way at all, please take a moment to leave a review over on iTunes, or alternatively, share it out on social media or with a friend who you think the podcast could help. If you have any questions or topics you'd like me to cover in future episodes, please connect with me via my Facebook group, Behind the Facade Community. And the long-time listeners will be aware that I have a YouTube channel called Gavin J. Gallagher, where I have recently begun posting these episodes. These actual podcast episodes are up there to watch, and shorter videos from the construction site that we have at the moment, and various other kind of bits of advice and stuff that I put up there. So go and check it out. If you're not a fan of YouTube, you can stay in touch with the various projects I am working on by joining my tribe over at gavinjgallagher.com. And while you're there, you'll be able to check out the online learning and education stuff that I have on the real estate business, including my mastermind. That's all for now, guys. I'll see you back here next week.